Hey traders, in today's video we'll be going over the right way to use Fibonacci retracements in your trading. Let's get started. So if you're on TradingView, simply move your mouse over the third button on the left and you should see a small arrow show up next to it. Click on that arrow to bring up the full list of options. The Fibonacci retracement tool can be found roughly halfway down that list, so click on that to select it. Here's what the Fibonacci retracement tool looks like when you first add it to your chart. Now double click to bring up the settings window. Scroll all the way to the bottom and you should see some additional settings. So we're going to untick the box labeled background, which simply removes the background color of the Fibonacci levels. And then above that, we're going to change the color to black. Next, we're going to untick the box labeled prices, and then we're going to change the next setting from values to percents. Next, we're going to change the labels from the left-hand side to the right. This makes the Fibonacci levels easier to read on your chart because they won't be showing up in the middle of the candlesticks. Then if we scroll back up to the top, we're going to untick all of the levels that are greater than 1. So double check that your settings are the same as what's on the screen right now, and let's continue. So let's imagine that we have a market that's currently in an uptrend. If you've ever looked at a price chart before, you'll know that markets don't go directly up or directly down. There are always pauses and pullbacks along the way. So a very simple example of an uptrend would consist of a move up, a retracement, a move up, a retracement, and a final move up. If you're looking to place a buy trade during this uptrend, then it makes sense you would want to get the best price possible for your trade. And this is exactly where the Fibonacci retracement tool comes into play. Fibonacci retracements allow us to predict how deep a pullback is likely to go against the overall direction of a trend. And when we're able to more accurately determine the end point of a pullback, this will naturally lead to better trade entries. So at the beginning of every price move, we have what's called a swing low. This is the lowest point that price has reached prior to a new high being made. So we have a swing low here, another one here, and another one here. A swing high, on the other hand, comes in at the end of the move up. This is the highest point price has reached prior to the retracement. So we have a swing high here and another one here. Now, in order to draw in our Fibonacci retracement levels in an uptrend, we draw it starting from the swing low and ending at the swing high. If drawn correctly, then you should have the 0% level at the top and the 100% level at the bottom. So the percentage levels on the right-hand side of the Fibonacci tool simply show us how deep the retracement goes before the uptrend continues once again. For example, if we saw only a very shallow retracement before a continuation of the uptrend, then that retracement may have stopped at the 38.2% Fibonacci level. If price was able to retrace exactly half of the move up, then it would have stopped at the 50% Fibonacci level. And if it was able to retrace deeper still, then it may have stopped at the 61.8% level. So by drawing in our Fibonacci retracement levels when we notice price is beginning to make a pullback, it can help us time our entry on that trade. There are a few tricks we can use to help predict which Fibonacci level price is likely to reverse at, which we'll go over in a second. Here's an example where the market is in a clear downtrend on the left-hand side of the chart. Price is continually making lower highs and lower lows, so at that point in time we would have been expecting further downside. We start to see a clear level of resistance forming on the chart. This level had 1, 2, 3, 4 rejections from price. So this level becomes important going forward, because if price is able to get above this level, it could signal a change in market direction. In this example, we see that price is able to break up through this level of resistance fairly easily. It even continues higher and is able to break above the previous high. So at this point in time, we could begin looking for a potential buy trade opportunity, and we can use the Fibonacci Retracement tool to help identify that opportunity. In order to draw our Fibonacci levels in, we first need to identify the swing low and the swing high. The swing low in this example clearly comes in here, as that's the lowest point price was able to reach. The swing high, on the other hand, comes in here, as that's where the upwards move ended. It's worth noting that before price made that new high, we would have had our Fibonacci levels drawn in using the previous high. So let's rewind for a second. Here we had our swing low, and then we saw a sharp move up breaking through resistance, which means at that point in time our swing high would have been right here. So we would have been using this as our swing low and this as our swing high. But as time went on and price kept moving, when the new high was created here, we would have adjusted our Fibonacci Retracement tool. So our swing low would have remained the same, but the swing high would have been changed to this new high here. Alright, let's return and draw in our Fibonacci levels. You'll notice that when using the Fibonacci Retracement tool, we always include the candle wicks. Some people draw their Fibonacci Retracement levels in using the candle bodies, but this is actually incorrect. The reason for this is because sometimes you'll get price moves that leave a very long wick behind. And so by using the candle body instead of the candle wick, you'll get a very different result from the Fibonacci levels that are generated. In this example, we see some support coming in at the 38.2% Fibonacci level. But eventually, price was able to break through that level and made it all the way to the 61.8% level. This was the Fibonacci level that ultimately resulted in the end of the pullback, and we saw a continuation of the uptrend shortly after. The reason why these Fibonacci levels tend to work very well, and why we often see reversals at these levels, is due to something called a self-fulfilling prophecy. Fibonacci levels are used by many different kinds of traders on many different time frames, and because of the fact that we have lots of traders all looking at the exact same levels on their chart, this is what causes these levels to become significant. The number one most important thing when using Fibonacci retracements is knowing which level to enter your trade at. The standard Fibonacci retracement tool has 5 different levels to choose from, so how do we know which level price is going to reverse at? Firstly, I would recommend avoiding the 23.6% Fibonacci level in the majority of cases. This level is only helpful during very strong market moves, where price is moving so quickly that it's unable to retrace to the 38.2% level. But in my experience, the majority of cases, price will move past the 23.6% level before the trend continues. The 38.2% Fibonacci level is my preferred level when entering a fast-moving market. So if you're looking to place a buy trade, you would first want to see a strong move to the upside. Seeing a move like this shows us that buyers are in control of that market, so we would be looking to enter at the 38.2% Fibonacci level. The reason why we use this level in a fast-moving market is the following. If buyers have shown a willingness to step in and push price higher very quickly, then it's unlikely that they'll allow price to retrace much lower than the 38.2% level. Whereas if we saw a slower move to the upside with many pauses and pullbacks along the way, we would be more inclined to use a different Fibonacci level. My personal preference in this kind of situation is to use the 61.8% level, as I find it to be more reliable than the 50% level. But it's important to test these levels out on the market that you trade, as your results may differ. The 78.6% level tends to work best when we have a market without a strong directional bias. For example, if neither buyers or sellers are currently in control of the market and we're seeing a lot of sideways price movement, this would be a good time to enter off the 78.6% level.